from one beaten down sector to another beaten down sector. Let's speak about the IT pack. Is there an exciting entry point here, or is there not? Is it still, uncertain out here? Let's get in Kumar Rakesh, who's the India analyst, auto and IT at BNP Paribas. After a big decline that we've seen in the IT pack, there were brokerages which still believe that, the decline is largely earnings-led and it is not multiple-led. And at times where it is multiple-led, it is justified as well. Where do you stand on that? And do you think after this crack that we've seen in the IT stocks, there is an attractive entry opportunity? If yes, then where?
Hi, good morning, and thank you for having me on the show again. So last week we were in Hong Kong, Singapore meeting investors, and we could see this very high level of bearishness that has gone into investors' expectation for the sector. Till last year, when we were meeting investors, till late last year, early this year as well, the only pushback that we used to get on our positive stance on IT was around valuation, although almost generally everybody had started accepting that the recovery is underway and we should start seeing better growth in the next financial year. And valuation was the only holding point. Now, while the valuation has sharply corrected, we noticed that investors now have started expecting next year growth to be similar or possibly much weaker than what the companies would report in FY25. Now, where to look from the entry point to your question, we think between now and April, we'll see more of consensus earnings cut, a little bit of more moderation in terms of what the next year growth will likely look. Companies will come out with their guidance in April month, and we think that they will set expectations also quite modestly and give guidance which could be conservative. And that we think should set the bottom in terms of expectation from the sector going into next financial year. And having already seen the valuation correction, we think by April, we will start seeing some attractive entry point to start looking at the sector favorably.
Okay, that's interesting, Kumar. Hi, morning. You're saying that maybe April onwards, there could be entry opportunities. I'm just throwing Citi's argument at you because yesterday that report was doing the rounds and they are of the opinion that at least for the large cap, let's talk large cap, let's leave out mid cap for the time being. Large cap IT growth rates now with the new reality in the US may still be about 4-5%, nothing more than that in the new fiscal. And then their argument was that valuations are perhaps therefore still expensive and still above long-term averages. Your thoughts on large cap IT?
Hi, Surabhi. So I think that is a very fair question if you look at from pre-COVID period when the growth used to be mid-single digit, about 5 to 7% for the sector. And the sector used to trade at multiples below 20 times. And hence, if that is the new reality that we are thinking that the sector is likely to continue to see these tepid growth levels, these valuations may start looking expensive. But our view is that demand outlook has dramatically changed post-COVID. Of course, there are macroeconomic headwinds, and that is what we are dealing with right now. But as we start coming out of this, we should start seeing growth, which is much better than what the numbers which we are talking about here. You just look at the YOY growth on a quarterly basis, not on the full year basis. Many of the companies in the Indian ITs among the large caps as well start moving towards the high single digit by third quarter or by fourth quarter of financial year. So if this incremental slowdown in the macroeconomy, which we are talking about, wouldn't have happened, we were already on the trajectory towards a high single digit sort of a revenue growth. And the demand tailwind from GenAI and the broader economic recovery in terms of multiple verticals starting to push growth hadn't already started playing out. So we still see that there is a path for a high single digit, close to double digit revenue growth for the sector. And if that is the case, we think looking beyond FY26, these valuations may still be justified.
This high single digit, almost touching double digit full year growth, by which year do you see this happening?
From FY27 onwards, so if you look at last couple of quarters, most of the growth was driven by BFSI vertical, where we had seen a broad-based recovery to start playing out. In December quarter, we started finally seeing recovery to start coming into CPG retail and energy and utility vertical. But there's a long tail of other verticals which were yet to start pushing growth for the sector. And that happens when the entire economy fully recovers. The signs of that we started seeing in the month of January, US manufacturing PMI, which was below 50 levels for the last 2 years, had started reporting numbers above 50, getting into expansionary phase. Manufacturing is one of the vertical which was still declining for the sector. And hence, from the broader recovery perspective, we had started seeing signs to come through by January. Of course, since then, things have moderated, and we'll have to moderate our expectation in the near term. But we shouldn't dramatically change the view from a long-term perspective.
What are the risks to your call here? Because, the macro data emanating from the US does point towards growth slowdown out there. So does the commentary coming in from a lot of the verticals out there, which, are big clients of the Indian IT services companies itself. You say that there are concerns of a demand slowdown, but it's not a sign of weakness, it's a sign of caution. When does that caution turn into weakness? What are the risks here?
Right. So the base case with which we are working with is the impact on the macroeconomy related to tariff and counter tariffs and related uncertainties is a transitory effect, possibly lasting a couple of quarters. And if that base case changes and we start seeing the impact of that to be more long lasting, that is the main major risk that we are working with. Last night, commentary from Fed was reassuring in that way. Even they see the impact of tariff to be transitory. While they are raising their expectation on inflation, they are not taking steps to act on it as yet, because they think these impacts are more transitory and should stabilize from as we move a few quarters from here. And that is the base case with which we are also working with in our estimates. But yeah, that is something we definitely need to keep watching out. If these things do not start settling down in a quarter or two, then possibly we'll have to take a longer look as well. How is this a new normal?
Finally, Kumar, on Midcap I.T, what are you liking? There are companies like Coforge that have just defied gravity, defied all odds, and they've just been, blazing ahead. There is the automotive space, names like KPIT, etc., which have been struggling last couple of quarters. Where do you see maximum growth in Midcap I.T?
So speaking with investors, at least the foreign institutional investors, they're not too keen to get back to Midcap IT. I think they have to need the broader market momentum to start picking up, and that's when the attractiveness of the Midcap IT starts coming back in. But if that happens, our top pick in that space is Persistent Systems, which has been delivering pretty solid growth despite the macroeconomic concerns. And as the demand recovers, and the GenAI demand starts picking up for them, we would expect that growth to start picking up. Looking at PEG ratio, it still looks quite attractive. From a long-term perspective, we think that is one of the stocks should be part of the portfolio. I happen to cover automotive as well, as you know, and in that space, we'll have to watch out how much of electrification acceleration is still needed from global automotive companies. Some of the European Commission and governments are looking at slowing down the electrification journey, and if that happens, that creates a headwind in terms of the demand for some of the automotive ER&D companies.
Absolutely. So we'll have to keep an eye, but and of course, lots of news flow. US, of course, still the prime driver as far as Indian IT is concerned. So remains on tender hooks for now, news related. But thank you very much, Kumar, for joining us this morning with that perspective. Appreciate it. Well, let's